and welcome to the Retirement Wealth Podcast. Today, we're diving into a topic that's becoming increasingly popular: how to invest in ETFs for retirement.
That's right, Emily. ETFs, or exchange-traded funds, can be a really powerful tool in your retirement planning arsenal, and they offer some unique advantages.
Absolutely. So whether you're just starting to think about retirement or you're already enjoying your golden years, understanding how to effectively use ETFs can really make a difference.
We'll touch on some key points, like what ETFs are, how they work, and why they might be a good fit for your retirement strategy.
Plus, we'll discuss the different types of ETFs available and how to choose the right ones based on your goals and risk tolerance.
Exactly, and we'll also share some tips on how to incorporate them into your overall investment strategy without feeling overwhelmed.
So, if you're ready to explore the world of ETFs and enhance your retirement planning, let's get started.
Sounds good to me, Emily. First off, let's break down what ETFs actually are and why they're gaining so much traction in the investment community. You know, Emily, with everything going on in the economy right now, it's more important than ever for people to really understand how to invest wisely, especially with options like ETFs.
Absolutely. I think a lot of folks are feeling the pressure, right? With inflation rates fluctuating, it can be daunting to think about retirement just around the corner.
Exactly. I mean, take John and Mary, for example. They're in their late 50s, and with rising costs, they're worried their savings won't stretch far enough. They thought they could retire comfortably, but now with everything costing more, they're feeling that pinch.
That's a real concern, and it's not just about the day-to-day expenses, but also the long-term ones, like healthcare. I mean, those costs can skyrocket as we age.
Right. Healthcare can be one of the biggest drains on retirement savings. I had a client recently who was looking at a potential $300,000 bill just for healthcare over the course of retirement. That's a staggering number.
Wow, that really puts things into perspective. And then you throw in the volatility of the market. It feels like every time you check the news, there's something that could shake up your investments.
Absolutely. Market volatility can be nerve-wracking, especially for those nearing retirement. I've seen retirees pull out of the market at the wrong time, just out of fear, and it can really hurt their long-term plans.
Yeah, and that's where ETFs come in. They can offer a way for people to diversify their portfolios, but still keep an eye on those costs, right?
Exactly. ETFs are often more tax efficient than mutual funds, which is huge for retirees. You want to keep as much of that money as you can, especially when withdrawals start.
And speaking of taxes, there are so many changes happening with Social Security and tax laws that it can be overwhelming. People really need to stay informed.
For sure. Just last week, I spoke with a couple who didn't realize their Social Security benefits could be taxed if their income exceeded certain thresholds. That's just an added layer they hadn't considered.
It's like every little detail matters even more as you approach retirement. I think a lot of people also underestimate the emotional aspect of financial security.
That's so true. The peace of mind that comes from knowing you have a solid plan in place is invaluable. I remember one client who was just so anxious about market dips. Once we set up a diversified ETF strategy, he felt a huge weight lift off his shoulders.
That's wonderful to hear. It's amazing how much confidence a solid financial strategy can bring. And let's not forget about legacy planning. People want to leave something behind for their loved ones, and how they invest now can really make a difference in that regard.
Exactly. I had a client whose parents relied heavily on Social Security, and they didn't have much saved. She was determined not to let that happen to her kids. We talked about using ETFs to grow her wealth, while also keeping some funds liquid for emergencies.
That's smart. It's all about finding that balance, isn't it? You want to grow your wealth, but you also need to be prepared for unexpected expenses.
Right. And with the current economic trends, people need to be more proactive than ever. Just looking at inflation, if your investments aren't keeping pace, your purchasing power can really erode.
That's a scary thought. So what can retirees or those approaching retirement do to navigate these waters?
Well, the first thing is really understanding your timeline. If you're looking at retiring in the next few years, you might want to be a bit more conservative with your investments.
That makes sense. And for those who have a bit more time, they could potentially take on a little more risk.
Exactly. Those who are still a decade or more away from retirement might benefit from a more aggressive ETF strategy. especially in sectors that have historically outperformed in inflationary periods.
And it's not just about growth, right? It's also about having some income-producing investments in the mix.
Yes, you want to consider ETFs that focus on dividends or income. That can provide a steady cash flow, which is especially helpful when you start drawing from your retirement accounts.
So it sounds like there's a lot to consider, but with the right approach, it can really help you feel secure as you step into this next chapter of life.
Absolutely. And while it may feel overwhelming now, taking things one step at a time can make it manageable.
That's a great way to put it. It's about creating a roadmap that fits your needs and goals.
Exactly. And that's what we're going to dive into next. Some core strategies for effectively investing in ETFs as part of your retirement plan. So when we're talking about investing in ETFs for retirement, it's really important to have a solid understanding of how they fit into your overall strategy, right?
Absolutely, David. And I think a good starting point is figuring out how much of your portfolio should be allocated to these ETFs. What's a solid rule of thumb for that?
Well, a common guideline is to consider the 70 to 30 rule, where you might allocate about 70% of your investments in stocks and 30% in bonds as you approach retirement. But, of course, it really depends on your risk tolerance and time horizon.
Right. So if someone's, say, 10 years away from retirement, they might want to lean a little more on the conservative side, maybe even shifting to a 60 to 40 split?
Exactly! And that's where ETFs can really shine, because they offer an easy way to diversify within those categories. For instance, you could have a broad market ETF for your stock exposure, and then a bond ETF for the fixed income side.
And using ETFs means you're not just putting all your eggs in one basket, right? So how do you choose which ETFs to invest in?
Great question. You want to look for ETFs that track indexes with low expense ratios. For example, an S&P 500 ETF can provide broad exposure to large-cap U.S. stocks without high fees.
Fees can really eat into your returns over time. I've heard that a difference of just a few tenths of a % can add up significantly over the years.
Yes, it's true. A 1% fee might not seem like a lot, but over, say, a 30-year investment period, it can lead to tens of thousands of dollars in lost growth. So keeping those costs down is crucial.
Speaking of costs, let's touch on tax-advantaged accounts. How do ETFs fit into 401ks or IRAs?
Well, the beauty of tax-advantaged accounts is that you can hold ETFs without worrying about the capital gains tax until you withdraw the funds. So if you're investing in a Roth IRA, for instance, any growth is tax-free when you retire, an incredible benefit.
That makes a lot of sense. And I suppose if folks are investing in a traditional 401k, they can defer taxes until they start withdrawing in retirement?
Exactly. But keep in mind, when you start withdrawing from a traditional 401k, you'll be taxed on those withdrawals as regular income. So balancing your withdrawals and tax implications will be key.
That leads us to the 4% rule. Can you explain that a bit more?
Sure. The 4% rule is a guideline suggesting that you can withdraw 4% of your retirement savings each year, adjusted for inflation, without running out of money over a 30-year retirement.
So if someone has $1 million saved, they could withdraw about $40,000 a year, right?
Exactly. But remember, the 4% rule is not a one-size-fits-all solution. It's based on historical market performance, and market conditions can change. Some experts suggest being more conservative, especially with today's economic uncertainties.
So maybe a bucket strategy could be a good alternative?
Yes, the bucket strategy involves dividing your retirement savings into different buckets based on when you need to access the money. For example, you could have a short-term bucket for the first few years of retirement filled with cash and conservative investments, and a long-term bucket with more aggressive growth investments.
I like that. It seems more flexible, and it can help in managing market risk, especially if the market takes a downturn.
Exactly. And, when planning these withdrawals, it's also crucial to think about Social Security. Timing your benefits can significantly impact your retirement income.
Right, I've heard that delaying Social Security can increase your monthly benefit. What's the rule of thumb there?
Well, if you delay taking Social Security benefits past your full retirement age, your benefits increase by about 8% for each year you wait, up until age 70. So, if you can afford to wait, it can be worthwhile.
So combining a well-planned withdrawal strategy with optimal Social Security timing can really enhance a retiree's financial picture.
Absolutely. And then there's the aspect of asset allocation, which is so important in managing risk. A diversified portfolio can help reduce volatility and improve returns over time.
What does a diversified portfolio typically look like in terms of asset classes?
A diversified portfolio often includes a mix of stocks, bonds, and maybe some alternative investments like real estate or commodities. A classic combination could be 60% stocks, 30% bonds, and 10% alternatives. But again, it really depends on your individual goals and risk tolerance.
And I suppose as you age, your allocation would shift more towards bonds, right?
Exactly. The idea is to reduce risk as you get closer to needing those funds. But, it's also essential to maintain some growth potential, even in retirement, to combat inflation.
Speaking of inflation, are there any strategies to protect against it in retirement investing?
Definitely. One approach is to include investments that traditionally outpace inflation, like stocks or real estate. Some investors also look into TIPS, or Treasury inflation-protected securities, which adjust with inflation.
That's a solid plan. And what about tax savings techniques? Are there any that retirees should keep in mind?
Oh, for sure. Utilizing tax loss harvesting, for example, can help offset gains and reduce your taxable income. Also, being strategic about withdrawals from your taxable versus tax-advantaged accounts can help manage your tax bill.
There seems to be a lot to navigate. I can see why working with a financial advisor can be so beneficial.
Absolutely. An advisor can help you tailor these strategies to your unique situation, ensuring you're on the right track for a comfortable retirement.
And now that we've covered some of the strategies, I think it's important to discuss some common pitfalls that people might encounter when planning for retirement.
Emily, one of the most common pitfalls we see with retirees is the sequence of returns risk. It's something that can really catch people off guard.
Right? That's when you experience negative returns in the early years of retirement, right? It can have a huge impact on your overall portfolio.
Exactly. Let's say you retire in a year when the market dips. If you start withdrawing from your investments while they're down, it can really hurt your long-term growth.
I've heard some retirees say they didn't think it would be a big deal, but it can really compound the issue.
Absolutely. I remember a client, let's call him John. He retired in 2008, right before the financial crisis. He had to withdraw from his savings during that downturn, and it put him in a tough spot for years.
That's such a tough situation. So what's the key to avoiding that kind of risk?
Well, proper planning is crucial. It's about having a diversified withdrawal strategy, maybe keeping some cash reserves to ride out those market downturns, for example.
That makes sense. And what about taxes? I feel like a lot of people don't consider how taxes will affect their withdrawals.
You're spot on there. Many retirees underestimate the impact of taxes on their retirement income. If you're withdrawing from a tax-deferred account, like a traditional IRA, those withdrawals can really add up and push you into a higher tax bracket.
Right, and that could mean losing more of your hard-earned money to taxes than necessary.
Exactly. I had another client, let's call her Susan. She didn't factor in taxes when she started taking withdrawals. She ended up taking out more than she needed just to cover her living expenses, and that pushed her into a higher tax bracket, which was a real eye-opener for her.
So what can people do to prepare for that?
It's really about planning ahead. Working with a financial advisor to map out a tax-efficient withdrawal strategy can make a huge difference. You want to balance withdrawals from different accounts, like taxable versus tax-deferred, to minimize your tax burden.
That sounds really important. And what about healthcare costs? I think that's another area where people underestimate their future expenses.
Yes, healthcare can be a real wild card. Many retirees don't account for rising medical expenses as they age. A common mistake is assuming Medicare will cover all their needs.
I've heard that too. Like, people thinking they won't need additional insurance or that out-of-pocket costs will be minimal?
Exactly. I had a client, let's call him Tom. He was shocked when he realized that his Medicare premiums, coupled with out-of-pocket expenses, were draining his retirement savings faster than he anticipated.
Wow. It's so easy to overlook that when you're thinking about retirement.
It really is. A good rule of thumb is to plan for healthcare costs to be a significant part of your budget. You might want to consider long-term care insurance or setting aside a dedicated health savings account.
And then there's longevity risk, right? People are living longer, which is great, but it can also put a strain on retirement savings.
Absolutely. Many retirees underestimate how long they'll actually be retired. I mean, it's not uncommon for someone to spend 30 years in retirement these days.
That's a long time.
It really is. I had a couple, let's call them Mark and Lisa, who thought their savings would last them comfortably until they were in their early 80s. But with better healthcare and longer lifespans, they started feeling the pinch in their late 70s.
What advice do you give to couples like Mark and Lisa?
I encourage them to plan for longevity. That means thinking about their investments and ensuring they're not too conservative too early. You want to have a balance that allows for growth even in retirement, especially with inflation.
And speaking of investments, what about poor asset allocation? That's another common mistake, isn't it?
Yes, definitely. Many retirees tend to become overly cautious and shift too much into bonds or cash, thinking it's safer. But that can lead to insufficient growth to keep up with inflation.
So it's about finding that balance between growth and safety?
Exactly. I had a client, let's call her Karen. She moved almost everything into bonds right after retiring. While it felt safe, it meant her portfolio wasn't growing enough to sustain her lifestyle long term.
That's such an important lesson. So how do people find that balance?
A diversified portfolio that includes a mix of equities, bonds, and maybe even some alternative investments can help. Regularly reviewing and adjusting your asset allocation as you age is also key.
And what about Social Security? I know that's a big topic too.
Yes, claiming Social Security too early is a mistake many make. Some retirees feel the pressure to take it as soon as they can, but delaying can actually increase their benefits significantly.
I've heard that can add thousands to your lifetime benefits.
Exactly. A client of mine, let's call him Steve, claimed at 62 thinking he needed the money right away. But if he had waited just a few years, his benefits would have been much higher, giving him more financial security.
So what should retirees consider when deciding when to claim?
It's important to evaluate your financial situation, health status, and whether you have other income sources. Everyone's situation is unique, so it's worth discussing with a planner.
That's such a great point. So if someone realizes they've made one of these common mistakes, what's the next step for them?
Most important thing is to take action. Review your financial plan regularly, work with a trusted advisor, and don't be afraid to make adjustments. It's never too late to pivot and ensure you're on the right track for a secure retirement.
Such valuable advice, David. It's all about being proactive, right?
Exactly. The earlier you can spot those red flags, the better equipped you'll be to avoid or recover from those pitfalls.
I love that. It really empowers listeners to take control of their retirement planning.
Absolutely. And remember, retirement is a journey, not a destination. Staying informed and flexible will serve you well.
Yes, I couldn't agree more. So what's next for our listeners?
Well, it could be a good idea to start reviewing your own retirement plan, identify any potential pitfalls, and maybe even schedule a consultation with a financial advisor to get a fresh perspective.
That sounds like a solid plan. Thank you for sharing all of this insightful information, David.
My pleasure, Emily. It's always great to help people navigate their retirement journey. All right, Emily. So now that we've covered the basics of ETFs and how they can fit into a retirement strategy, let's talk about some immediate steps people can take.
Yes, I'm excited to dive into that. What's the first thing folks should do?
A great starting point is to assess your current investment situation. You can, take a look at what you already have in your portfolio. It's important to review it quarterly, just to ensure it aligns with your retirement goals.
Absolutely. And for those who might feel overwhelmed, where can they find resources to help with this assessment?
Well, there are several great online platforms. For example, Vanguard, Fidelity, and Schwab all offer retirement calculators that can give you a clearer picture of where you stand financially. They can help you project how your investments might grow over time, considering different factors like your contribution levels, expected returns, and even inflation.
That sounds really useful. Is it as simple as plugging in some numbers?
Exactly. Just enter your current savings, desired retirement age, and planned monthly contributions. It'll give you a personalized projection, and you can play around with different scenarios. It really takes the guesswork out of planning.
I love that. And what about taking action on those projections?
But once you see those numbers, it can help you identify if you need to adjust your savings rate or investment strategy. If you're behind, maybe consider, increasing your contributions or exploring different investment options like ETFs.
Right. And for those who might be unsure about which ETFs to choose, what do you recommend?
A good approach is to start with broad market index ETFs, like an S&P 500 or total market ETF. They offer diversification and tend to have lower fees. Also, make sure to check the expense ratios. Lower is generally better.
And what about bonds or international ETFs? Should people consider those as well?
Yeah, absolutely. Depending on your risk tolerance, adding some bond ETFs can help stabilize your portfolio. And international ETFs can provide additional diversification, which is key in mitigating risk. Just, be mindful of the currency and geopolitical factors that might come into play.
Great points, David. And what about some tools or apps people can use to manage these investments effectively?
There are some fantastic financial planning apps out there. For instance, Personal Capital and Mint can help you track your spending, investments, and overall financial health. They give you a holistic view of your finances, which is super important as you plan for retirement.
I see how that could really help. And are there any particular books or podcasts you'd recommend for listeners looking to deepen their understanding of retirement planning?
Definitely. The Simple Path to Wealth by J.L. Collins is a fantastic read, very approachable and full of solid advice. And for podcasts, Choose FI is excellent. They cover a wide range of topics from financial independence to smart investing strategies.
Those sound like solid recommendations. What about habits? Are there small, actionable habits that people can start today?
Sure. Start by setting a recurring reminder to review your portfolio, maybe quarterly. That way, you can keep an eye on your investments and make adjustments as necessary. Also, running retirement projections at least once a year can help you stay on track.
That makes so much sense. And it's, a manageable step that won't feel overwhelming.
Exactly. It's never too late to improve your plan. Even if you're nearing retirement, making small adjustments can have a significant impact.
So true. And I think that mindset is really empowering for listeners, knowing they can take control of their financial future.
Absolutely, Emily. And remember, every little step counts, whether it's educating yourself, adjusting your contributions, or simply keeping track of your investments.
With all these tools and steps, listeners can really set themselves up for success.
Right. So those are some practical first steps. Now let's bring this all together. Well, as we wrap up, let's take a moment to highlight some key takeaways from our discussion on investing in ETFs for retirement.
Absolutely, David. First off, we talked about how ETFs can be a great way to achieve diversification, right? They allow you to spread your investment across various sectors without having to pick individual stocks.
Exactly, and that's crucial for managing risk. Then we also touched on the importance of keeping an eye on expense ratios. Lower fees can really make a difference in your overall returns over time.
Right, and we can't forget about liquidity. ETFs are generally easier to buy and sell compared to some mutual funds, which gives you more flexibility, especially as you approach retirement.
And let's not overlook tax efficiency. ETFs often come with tax advantages compared to other investment vehicles, which is key for retirees looking to maximize their income.
Yeah, and finally, we emphasize the importance of aligning your ETF choices with your retirement goals. It's not just about investing, but making sure those investments fit into your bigger picture of financial security.
That's so true, Emily. Building and protecting your retirement wealth is a journey, and being informed and strategic can really set you up for success.
Well said, David. If you found today's episode helpful, please take a moment to like, subscribe, and maybe even drop a comment with your biggest takeaway or any questions you have.
And don't forget to share this episode with someone you know who's planning for retirement or is already in it. They might really appreciate the insights we've discussed.
Next time, we'll dive into tax-efficient withdrawal strategies explained. It's going to be a great one, so you won't want to miss it.
Absolutely. Thanks for joining us today, and we look forward to seeing you next time.
Take care, everyone.